Welcome to Tech Money Madness, your daily U.S. stock market podcast. It is June 2026. And what if I told you the biggest stock market surge in history isn't being driven by hype or emotion or, some vague hope for the future?
Right.
It's actually being driven by cold, hard silicon and undeniable cash flow. So, welcome to today's deep dive. You, our listener, have brought us this incredibly fascinating stack of notes today, right alongside the daily market briefing.
It is a phenomenal briefing to read through, honestly. I mean, usually when we see the market moving this fast, the alarm bells start ringing.
Oh, absolutely.
But the data you've brought us today is just painting a very different, much more grounded picture.
Which is exactly our mission for this deep dive. We want to cut through the daily noise of these massive market movements,
Right.
We are going to extract the real drivers behind these current record highs.
Exactly.
And we want to look specifically at how artificial intelligence has stopped being just a buzzword and started fundamentally reshaping the financial landscape. Okay, let's unpack this.
Let's do it.
Because the language in this briefing is striking. It describes the current surge in the S&P 500 as a melt-up. Now, conventionally, a melt-up is like the terrifying prequel to a meltdown, right?
That is the traditional wisdom, yes.
Yeah.
A classic melt-up is often fueled by what economists call irrational exuberance.
Irrational exuberance.
Right. That's when asset prices skyrocket simply because investors are acting on herd mentality. It's totally psychological.
Right.
People buy in because they see prices rising and they just don't want to miss out, not because the underlying companies are actually worth more.
So it's like a massive sugar rush. You eat an entire bag of candy, your energy spikes through the roof, you run around frantically, but inevitably you just crash.
Yeah, exactly.
There's no real nutritional substance keeping you going.
I love that analogy because what the briefing shows us today is the exact opposite of a sugar rush. What's fascinating here is how the market is actively shifting its reward system right now.
How do you mean?
Well, this current melt-up is actually being driven by hard earnings momentum. I mean, these companies aren't just promising a shiny AI future anymore. They are proving that their AI integration is driving real-world, highly profitable revenue today.
So instead of a sugar rush, it is more like an athlete who has spent, months in the gym legitimately building dense functional muscle.
Yes.
The heavier weight they are lifting, which in this case is the tech-led S&P 500 hitting record highs, is actually supported by real strength.
Beautifully put. For a long time, the tech sector was rewarded for mere potential, like, we'll capture the market in 10 years, or we'll be profitable eventually.
Right, the whole growth at all costs era.
Exactly. But today's market is demanding proof. The foundation of this rally is mathematical. It's built on balance sheets, not just emotional momentum.
Well, if actual undeniable earnings are the muscle driving this market higher, we really need to look at who is doing the heavy lifting here. The briefing points to a massive validation on both the software and hardware sides. So what is the data telling us about the software layer?
The prime example in your notes today is UiPath. They just reported their fiscal Q1 2027 results, and honestly, it's a stellar report. They achieved a massive 17% revenue growth.
Wow, 17%.
Yeah, and they subsequently raised their forward guidance for the rest of the year.
And the market rewarded that immediately, right? Their stock surged 11.9% today.
It did.
But help me understand the mechanism there. What is UiPath doing with AI that turns into that kind of immediate cash flow?
So they build AI automation software. Think about a massive global corporation that employs, thousands of people just to do repetitive data entry or process invoices or route customer service tickets.
Okay, sure.
UiPath's AI agents can now automate those complex, multi-step processes almost instantly. They are essentially selling a product that drastically reduces a company's operating costs overnight.
Oh, wow.
And when you sell efficiency at that scale, the revenue growth follows naturally.
That makes total sense. They are selling the shovel in the gold rush. But that software has to run on something physical. Which brings us to the hardware side of your briefing. And looking at these notes, well, NVIDIA seems to be operating in an entirely different stratosphere.
Oh, without a doubt. They are the absolute anchor of this earnings momentum. NVIDIA isn't just riding the wave, they are creating the ocean.
They really are.
The briefing highlights two massive new initiatives they just announced. The RTX Spark Superchip, designed specifically for PCs, and something called the Vera CPU.
Yeah, I saw the Vera CPU mentioned in the notes, along with a frankly staggering number. The briefing says this single CPU opens up a $200 billion total addressable market.
It's massive.
For those of us who don't spend all day on Wall Street, What does a total addressable market, or TAM, actually mean in this context?
So a total addressable market is basically the entire pie of potential revenue for a specific product or service. When analysts say the Vera CPU unlocks a $200 billion TAM, they mean that globally, companies are prepared to spend $200 billion upgrading their data centers and cloud infrastructure to handle advanced AI workloads.
And NVIDIA wants that whole pie.
Exactly. NVIDIA has just positioned the Vera CPU as the foundational architecture to capture that exact spending.
200 billion from one component. That is just wild. But here's where it gets really interesting. It's not just about NVIDIA getting bigger. The briefing notes a fascinating ripple effect. Because NVIDIA's new RTX Spark is built on ARM's architecture, ARM Holdings saw its stock explode by over 15% today.
Yeah, it was incredible to watch.
So NVIDIA makes a chip, and a completely different company's valuation surges. Why does that happen?
It comes down to how these modern chips are actually created. ARM doesn't manufacture physical chips. You can't, go to a factory and watch an ARM chip roll off an assembly line.
Oh, right. They don't fabricate them.
Right. Instead, they design the incredibly complex blueprints for hyper-efficient processing.
Oh, I see. They're the architects, not the construction workers.
Precisely. So when NVIDIA says they are building the groundbreaking RTX Spark, they aren't starting from scratch. They are licensing the blueprints from ARM.
Got it.
If we connect this to the bigger picture, this is exactly why artificial intelligence is a systemic dominant theme, rather than just an isolated sector. When NVIDIA innovates, they instantly create wealth for their architectural partners.
Let me make sure I have this straight. Traditional computer chips were built to process tasks sequentially, right? Like a chef cooking one meal at a time. But AI requires parallel processing.
That's the perfect way to look at it. AI needs a system that acts like 10,000 chefs cooking a massive banquet all at once.
Okay, so NVIDIA builds the kitchen that can hold 10,000 chefs. ARM draws the blueprints for that kitchen. And companies like UiPath are the restaurant managers using those 10,000 chefs to completely rewrite how fast businesses can operate.
It is a perfectly interlocked ecosystem.
Every layer feeds the next, and they all profit together.
Exactly. And because the market sees this tangible, interconnected growth, it fuels that healthy muscle-building melt-up we started our discussion with.
But, in a technological leap this massive, if a whole new ecosystem is surging ahead, someone naturally has to be falling behind. The briefing has a top losers column today, and it tells a pretty brutal story.
It really does. Right at the top of the losers list today are the legacy chip makers, Intel and AMD.
Yeah, the old guard.
This is the changing of the guard playing out in real time.
The old guard of computing architecture is shedding value on the exact same day the new guard arm in NVIDIA is surging by double digits. Why are Intel and AMD struggling so much to keep up? I mean, they've dominated the hardware space for decades.
It goes back to your chef analogy. Intel and AMD spent decades perfecting the sequential processor, that single incredibly fast chef.
Yeah.
And they are brilliant at it. But pivoting massive manufacturing operations and completely redesigning legacy architectures to prioritize AI's parallel processing demands, that takes years. They are trying to turn an aircraft carrier while NVIDIA is driving a speedboat.
But not all the legacy giants are taking this lying down. The most active stocks in today's briefing aren't just the chip makers. It is NVIDIA, sure, but also Microsoft and Amazon.
Yeah.
Both Google and Microsoft are noted as pouring massive, unprecedented investments into AI infrastructure.
Right. They are basically buying up all those NVIDIA chips as fast as they can be made.
Oh, so aggressive.
They recognize the existential threat. Microsoft, Google, Amazon, they know they have to spend heavily on capital expenditures right now building these massive data centers or risk losing their dominance in the next decade of computing.
Which brings up a tension point in the briefing that honestly confused me.
Oh.
Yeah. So we know Amazon is aggressively chasing this AI opportunity. The briefing explicitly states that Amazon remains an attractive buy, specifically because of its strong AI growth prospects. But then, literally in the next sentence, it points out that Berkshire Hathaway Warren Buffett's holding company recently sold Amazon stock.
Ah, yes.
So hold on. If Warren Buffett's team, the ultimate value investors, are selling Amazon, how can the briefing confidently call it an attractive buy for you, our listener?
This raises an important question about how different investors view the exact same data. It really comes down to fundamentally differing investment philosophies.
Break that down for me.
Sure. Berkshire Hathaway practices traditional value investing. They look for companies trading below their intrinsic book value, meaning the company's physical assets and cash are worth more than the stock price.
Right.
And they want highly predictable, steady, near-term cash flows.
They want the sure thing, the established railroad, the insurance company, the beverage brand that just churns out a predictable profit every single quarter.
Yes. But the AI supercycle requires a totally different lens. Think about those heavy capital expenditures we just mentioned. Amazon is pouring billions of dollars into AI data centers today for exponential returns 5 or 10 years from now. Okay. A value investor looks at those billions leaving the bank account, sees near-term profit margins shrinking, and decides to sell.
Ah, so it's not that Buffett thinks Amazon is doomed. It's just that Amazon's aggressive AI spending no longer fits the specific rigid blueprint of a value portfolio.
Exactly. But a growth-oriented analyst looks at those same billions being invested, looks at the $200 billion markets being unlocked by AI, and sees Amazon positioning itself to capture unparalleled future revenue.
That makes a lot of sense. So the big headline about a famous firm selling a stock doesn't automatically mean the fundamental tech outlook is flawed. It just means different games are being played on the exact same field.
Precisely.
Okay, so we have the blueprints from ARM, the chips from NVDA, the massive cloud data centers being built by Amazon and Microsoft, and the automation software from UiPath. But all of this massive infrastructure isn't just floating in the ether. It needs a physical endpoint to actually reach the consumer. Where does this hit the street level?
It hits the street level in the device that is likely sitting within arm's reach of you right now, the global smartphone market. And the economic data in your briefing shows a hardware horizon that is poised for a total explosion.
I am looking at these numbers, and they are enormous. The briefing projects the global smartphones market will grow from $609.29 billion today in 2026 to $739.23 billion by 2031.
Yeah, the scale is incredible.
That is roughly $130 billion of growth in just 5 years. I have to push back on this, though.
Go for it.
Wait, almost everyone I know, from my 10-year-old nephew to my 80-year-old grandmother, already has a smartphone. How is there still over $100 billion of growth left in this market in just 5 years?
It is a completely fair objection. I mean, if you only look at developed markets, it does feel like everyone is already equipped.
Right.
But that $130 billion isn't primarily coming from giving a phone to someone who has never had one. The briefing breaks down 3 specific drivers forcing this growth: increasing 5G adoption, entirely new AI-powered features, and expanding penetration in emerging markets.
Okay, I understand emerging markets expanding the pie. But break down the 5G and AI features for me. How does that create new value if I already own a perfectly good phone?
It is all about the upgrade cycle. For the last several years, you've probably noticed that the difference between a phone from 2023 and 2025 wasn't really game-changing. People held onto their devices much longer.
Yeah, a slightly better camera didn't justify the cost of upgrading.
Exactly. But we have hit a hard inflection point. All those advanced AI features we talked about, the real-time language translation, the advanced automation, the generative assistance, they are being pushed directly to mobile.
But wait, can't my current phone just access those tools through the cloud? Why do I need a new device?
Because of latency and processing power. Sending a complex AI prompt to an Amazon data center, waiting for it to process and sending it back takes time.
Right.
For real-time applications, that delay is unacceptable. The industry is moving toward on-device AI, meaning your phone needs a dedicated neural processing unit, a miniature version of those AI chips built right into it. Your current phone physically does not have the hardware or the RAM to run the new AI models natively.
Oh, wow. So it's forced technological obsolescence.
Pretty much.
To participate in the modern digital economy, to use the baseline tools that are becoming standard for work and daily life, consumers in developed markets have almost no choice but to upgrade to these premium, higher-margin models.
Yes. The server farms need the Vera CPUs, which use the ARM blueprints, to deliver the UiPath automation to your brand-new 5G AI-native smartphone.
The software demands better hardware, the hardware unlocks new software, and the consumer has to buy a new device to access any of it. It is a perfectly synchronized supercycle.
It is.
Which brings us to the ultimate question for you listening today. With all of this hardware and software growth happening simultaneously, and total addressable markets expanding by hundreds of billions, how is the broader investment community actually playing this market?
Well, the briefing synthesizes the landscape into 4 overarching themes: AI dominance, earnings momentum, growth prospects, and sector trends.
We've traced how these connect, yeah.
But what is most revealing is the strategy section. The market is bifurcating into two very distinct camps.
The notes show investors are either hunting for growth stocks with strong prospects, like the Amazons and NVIDIAs we discussed,
Yeah.
or they are turning to dividend-paying stocks to hedge against market volatility.
Exactly.
So the question for you is, which camp do you fall into? Are you looking to strap yourself to the fast-moving tech rocket ships, knowing that the heavy capital expenditures might make the ride bumpy, but the destination is entirely new galaxies of growth?
Right.
Are you looking for the steady, reliable anchor, the dividends?
Right. And we should clarify for our listeners, a dividend-paying stock is a company that routinely pays out a portion of its actual profits directly to shareholders as cash, rather than reinvesting all of it back into massive growth projects.
The companies that might not make the front page of the financial news, but will reliably put cash in your pocket while the rest of the market figures out who ultimately wins the AI race.
What is vital to understand is that multiple perspectives actually enrich an investor strategy. Even if you are an aggressive growth investor heavily indexed in the AI supercycle, you have to acknowledge that the billions being spent on infrastructure will create near-term volatility.
That makes sense.
Having a foundational understanding of value, perhaps holding some of those dividend-paying anchors, provides the stability needed to ride out the turbulence of the growth sectors.
It's about balancing the portfolio. You want the muscle of that earnings momentum, but you don't want to lose your core stability.
That's it.
Well, this has been an incredibly enlightening deep dive. We set out to understand the real muscle behind the S&P 500 highs, and the briefing really delivered. We've seen how actual, undeniable earnings, not just hype, are driving this massive AI supercycle.
We have.
We've traced how an innovation by NVIDIA creates a $200 billion market and sends 15% ripples through architects like ARM Holdings. We explored why legacy players like Intel are struggling to pivot their massive ships, while giants like Microsoft and Amazon pour billions into the future.
Yeah.
And we followed that data all the way down to the street level, uncovering the mechanisms driving a $130 billion global smartphone upgrade cycle. Thank you so much for bringing these notes to the table.
It is a remarkable time to be analyzing these markets, but I want to leave you with one final thought to mull over, something that builds on everything we've unpacked today.
Okay.
We talked about NVIDIA unlocking $200 billion for its new CPUs, and the smartphone market adding over $100 billion as billions of consumers upgrade to 5G and AI-native devices. We are constructing an incredible, sprawling digital ecosystem. But what happens when the physical infrastructure, the global energy grid, the copper wiring, the raw material supply chains for batteries, and the massive cooling systems required by these data centers struggles to keep up with the unprecedented power demands of this new AI-driven reality?
Wow. The digital mind is expanding at an exponential rate, but the physical body might soon struggle to feed it.
Exactly.
That is a heavy, fascinating question to carry with you today. Keep questioning the world around you. Keep looking for the real mechanisms underneath the market movements. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.